So today I'm doing the stocks I'm buying June 2024 edition. This is where I go through all the stocks that I'm buying and selling in my portfolio. Now I did my UK one a few days ago, and this is all the US stocks that I have bought and sold in my portfolio. So anything that I've done from the 1st of May to the 1st of June is going to be on this video here today. And it just keeps up that transparency. I've done it for many years. You can track along with how I'm doing. I don't hide anything. Some other YouTubers will come on this scene and start promoting about a stock that they're up on so much, and they won't ever talk about when they bought it. They only talk about it when they're up a certain amount. So they go, hey, look, I'm a genius. And sometimes they'll buy something and it won't work out, and they'll sell it quietly in the background and hope you guys don't notice it. Try to do things a bit different around here on this YouTube channel. You can see if I'm buying things and they go up, or I'm selling things and they go down. You can actually judge me on how my investments are going, and it's probably why it's the most popular video that I do on the YouTube channel. So we'll go through these stocks that I'm doing, been buying and selling in the month of June. And if you could, hit the like button if you're new around here and you enjoy this video series. Make sure you subscribe, and we'll get started on today's video. And as always, if you do want to know what I'm buying and selling in real time, the place to be is on the Patreon. You join through the link in the description, and you get to know my live buy and sell alerts in there in real time. As well as that, you get a Discord with 500 members on to talk about stocks, including me. And you'll also get 2 exclusive videos on there. So for example, we just dropped this video here, which was the stock request. This is where members of the Discord vote for me to take a look at a stock, which was Kering, and I, who own Gucci, and I take a look at Kering and give my thoughts on where I think Kering might go in the coming few years, and if I think it's a potential buy. And all that is £5 a month. The price of a pint is not too bad at all. It's probably why it's the highest Patreon to subscribers out there on the whole stock market YouTube scene. And if you want some free shares, that's personally the broker that I use. Join through the link in the description. You get a free share worth up to £100 as well if you do want to start investing. Now, first of all, Darktrace. So most of you guys will know that I used to own Darktrace. It's not on the buying list, don't worry. So I used to own Darktrace. However, what happened is Darktrace had a cracking year. It was up 71% and they got bought out. So I made a good amount of money. I was up, nearly 100% on this position. But my problem is that this was my cybersecurity play. I've always said to you guys, I want to have a cybersecurity play because I think the area is going to grow massively. You just go on your emails, you probably see that some data you have with a certain company, or a company that's posting about them being attacked, or they've had a cybersecurity attack, and the growth or the attacks that are happening in this area are just happening more and more and more, and it's growing fast. This area is a fast growing area at the moment, and I always wanted to have a cybersecurity play. Now what I did in about a year ago, or maybe a year and a half ago, is I bought Darktrace. I thought this is going to be my play. I like the growth, I like the valuation, and I'll hold it for many years as this cybersecurity carries on. The attacks keep increasing, and if anything, the attacks from AI are going to probably increase this even more. I'm just going to keep holding this for many years, and it'll do very well. Now, it did do very well for me. I just thought it would be for many years, not just in 1.5 years, and then my cybersecurity play was lost because they were bought out. So that led me to kind of go, well, I need to get another cybersecurity stock in here. So I was having a look around the market of a potential stock to go buy. So I was looking at Palo Alto Networks, looked at the stock, 42 times earnings, which was basically the same as Darktrace. But the problem with Palo Alto Networks is that it was hardly growing. The EPS, as you can see here, wasn't doing a very good job of growing. And if you look at the revenue, yeah, it's going to grow 16% this year and 13% next year. But Darktrace was growing at 20+%. And I was like, this isn't really looking attractive for me. So I went out and bought the #1 player in this space. So this is a brand new stock. I've never mentioned it on the YouTube channel before. Only you guys on the Patreon know that I've actually bought a stake in this company. But I did buy a position in Crowdstrike. So I decided to just go out and buy the #1 player in the whole cybersecurity industry. I thought, let's just buy the leader, because at the end of the day, most of the businesses are just going to them now. And they're leading so much in technology that they're not having any slowdowns of an issue like Palo Alto Networks. They just keep taking more and more market share because they're the #1 provider. The products are just ahead of everybody else's. Now, Crowdstrike have won many awards because of their products. They are the leader by far. They have quite a few products here, so you can see here that I've gone on a quick little pricing list here. So you can see you start off with maybe one product, which is like the Falcon Prevent, which is the general antivirus, as you can see here, and then you can add in more coverage and more security depending on probably the size of your business, or if you're just using it personal, as you can see here. So there is many options to extend the cybersecurity depending on your business size, and your also need with coverage inside the business. Now the company itself is performing absolutely amazing. You know, we just talked about Palo Alto Networks growth here. It's around about 16-13%. Crowdstrike is obviously a lot stronger than that as the market leader, and the more products that they do offer. The growth wise, or ARR, was up 34%. Customer spending 1 million or more was up 33% year over year. Operating margin is expanding, so the margins they're making on this business is just impressive. The profitability is ramping up a lot more than the revenue, as you can see here. Diluted EPS was up 102% year over year. Free cash flow was up 35% year over year, and free cash flow margin was 33%, which is very healthy margins. I think there is only like 10 companies in the world that are growing at 10% revenue growth a year with over 30% free cash flow margins, and Crowdstrike is one of them, which kind of shows you how impressive it is. There's only 10 companies that do this level of growth and this free cash flow margin, and that's why it's one of the premium companies out here. And you look here at the moment that they have modules, and like I said, the more modules these companies have, obviously the more tied into using the Falcon platform that Crowdstrike offer. Rather than just having one module, the company sign up and go, we really like CrowdStrike, it's helping us with our cybersecurity, we're having less attacks. They start signing up for more and more. That also creates that little bit of that moat effect as well, where if companies are tied into using more products, it also means that they really like you, but also that there's more of the switching cost rather than having to do things maybe individually between a lot of platforms. They get it all here with Crowdstrike, and it's less of an issue if they're wanting to go split up and get some of those products from other competitors. And you can see that 7 modules is now at 27%. So this is really good, is that people are increasing more and more. And if you have a look here, deals with 8 or more modules is more than doubled year over year. So that's what we want to see. You get that kind of moat tied in, that they're using more and more modules from Crowdstrike, but it's also doubling. So the people that are using more and more is increasing at a very good rate. Now the big issue I've always had with Crowdstrike is that it's the leader here. It's using AI as well now to try and improve its cybersecurity. Its retention is absolutely amazing. Obviously we've already said, it's one of the best growth to free cash flow margins businesses that is out there in the whole stock market scene. The problem I've always had with Crowdstrike is the valuation. that's always been the issue here. And you can see at 855 times earnings, even though it has just kind of turned profitable, that's why it looks so high. Even if we look at a forward P, I think it's something like a 74 times earnings. So it is always a richer valuation. And even now, you're paying up 82 times free cash flow. Now, the lowest it's ever been is 36 times free cash flow. And I think people always think like, at the end of the day, you're never going to get Crowdstrike free. This is one of the best companies in the whole stock market scene, and you're never going to get it for cheap. However, me paying up 82 times free cash flow, I was kind of like, that I don't like doing that. And I have paid for a very high and expensive stock. It's a quality stock. However, it is a very expensive stock. And sometimes you do need to pay up for the quality businesses. And I think that is what's going to happen with Crowdstrike. Now, my hope is that it can go cheaper. If you look at free cash flow rate, it's about where it should be at the moment. It's definitely not to the higher side, but it's definitely not to the lower side. So my thinking is what I was kind of like, I need this new cybersecurity play in here. What I'll do is I'll use some of the profit from Darktrace in here. I'll buy a big chunk now, and I've got a startup position. And at the end of the day, if Crowdstrike does go up from here, I'm going to make money. So in the next 5 years, is Crowdstrike going to be higher? Yeah. So I think even if I buy at these levels, I think it's going to be higher than where it is right now, and I make money. Now, hopefully, my game plan is that it actually goes down. And if Crowdstrike was to drop 30-40%, then guess what? I can now actually buy Crowdstrike at its lower side of the free cash flow multiple it's ever traded at. And then I can increase my position, and then I make money because I think Crowdstrike is going to be higher than where it is right now in the next 5-10 years anyway. So that's my game plan. It's probably one of the most I'm going to use the word overvalued, but it's definitely a rich valuation. It's one of the richest valuations I've ever paid up for a company. However, when you're desperate to get another cybersecurity play in your portfolio, I've gone for it. So we'll see what happens. I bought a position here. I will probably never touch Crowdstrike again unless it drops like 30-40% from here, but I did buy a position in Crowdstrike, so thought I'd let you know about that one. The next stock I bought was PDD Holdings. I did buy some more shares in PDD this month. The stock basically came out of earnings. The stock basically stayed flat, and I was like, hold on. The stock was flat on probably the biggest beat I think I've ever seen a company do on an earnings season. So I was going, okay, if the fundamentals are improving, but the share price isn't, I'm going to start buying some shares in the stock. And since then, the stock has started to go up a little bit, but I still think 19 times earnings for this business is not very fair. Even if you consider it is a Chinese stock, I still think it should be trading at a lot more of a premium than what it is right now. Anyway, PDD, I'm sure most of you know, one of their new additions is Temu. Temu is taking the world by storm. Obviously, people are desperate to get cheaper products at the moment, especially with the environment that we're in and the consumer environment. People do not mind waiting them 3 or 4 extra days for it to come from China if they're getting a product for half the price. And Temu, compared to Shein, rather than just being a clothing brand, they are selling everything. So they're selling clothes, they're selling a lot of house products as well, and that's why it's also had the potential to overtake Shein. Now, we saw how well Shein did, but Temu is doing even better because of the range of products that it is selling. And it's expanding worldwide. It's expanding into new locations, into like the Latin America, Europe, for example. And we're seeing the evidence of how much people are really enjoying using PDD. This is probably one of the best earnings beats I've seen a company do. So look at this. EPS of $2.83. This beat by nearly $1.40. So we had nearly a double beat on the EPS. I don't think I've seen that for a very long time. Revenue growth of 131% year over year. Now, just to remind you guys, analysts were expecting around about 50% revenue growth around about 6 months ago for this quarter. That's how quickly they've gone ahead of expectations, and they beat by 1.4 billion. Not million, 1.4 billion they beat by on a 12 billion revenue. That's insane. Absolutely crazy. And the company's trading at 12 times forward earnings. 12 times forward earnings for a company growing at 131%. I mean, if this was called Nvidia, this stock would have been up 100% off these earnings. It would be crazy. I just can't believe, even if you're taking the point of view that it is a Chinese stock, I still don't think you should have a company trading at 12 times forward earnings that's growing 131% year over year and beating your EPS by double the forecast. It's just absolutely crazy to me. And financial health wise, is a very healthy business. If you look down here, there's 2% debt to equity at the moment, and they sit on a really healthy cash balance, as you can see here, around about 242 million Chinese yen here at the moment on the cash balance, which is really incredible. The profit they throw off the business as well is incredible as well. So they're going to have a lot of options what they potentially could do with that cash pile, whether it be dividend, a share buyback. They're going to have a lot of options here, as you can see here. And if anything, if you look at the growth forecast, it's not forecasting to slow down anytime soon as they keep expanding Temu internationally. Now, just a quick shout out, I do get asked a lot about that platform that I just used in that video there for PDD, which is Simple Wall Street, as you can see, top left corner here. Now, Simple Wall Street, if you do click on this link in the description, it will take you to this page. You can see I'm currently on the highest product they offer, which is the unlimited, but you might want to try it for free, which is this one here. You get a 14-day free trial, and after the 14-day free trial, Simple Wall Street will actually send you a 30%, I believe, discount code. If it's not 30, it's actually 40. A 30% discount code, and you'll get 30% off your yearly plan if you do click through that link. So if you do on that platform, I get asked a lot about it. I use it in my videos all the time. I use it every day myself. It's probably for me the best stock market platform to start with. Really good amount of information, really easy to get through a lot of companies' information on there, as you saw with PDD. If you want to try that, link is in the description anyway. Next one, Fiverr. So I did buy into Fiverr. Now the thing with Fiverr is I was waiting to see the Q2 results, and I was wanting to see an improvement in the Q2 results, and I got it. The Q2 results were really good, so I thought, you know what, I'm going to buy some more shares. Now, since the Q2 results have come out, you can see here the stock is up a lot more since those results, so I did buy as the stock did start rising after those results. But obviously Fiverr, it has a lot of freelancers out there that offer a lot of their services, especially with AI at the moment. A lot of companies want to have AI developers, and a lot of them are going to these freelance services like Fiverr, for example. And also a lot of companies themselves. I think Google alone, I think 50% of their workforce is actually powered by freelancers, which a lot of people don't know. So it's a very big growing area at the moment, as it suits companies and individuals that get to select who they work with, what products to take on, and what they can charge here at the moment. Now, like I said, the Q2 results were very good in my opinion. You do get this company trading at 11 times forward earnings, which I think is pretty decent. You get it growing at 6% a year, which is very good growth. Beat by EPS, revenue was a beat as well. Now, a lot of people looked at the active buyers being down 6%, but if you actually look into Fiverr's earnings in a little bit more detailed, you'll see the reason why is they're not trying to improve the people that are using the platform or attract people to the platform by big sales and marketing spend. What they're wanting to do is get the current spenders to buy more. That's what they're focusing on. So if you actually look at the spend per buyer, it reached $284 compared to $262, with an increase of 8% year over year. Now they're focusing on the big products. They're focusing on the products that take 3-4 weeks to design. So like AI products. A lot of people say to me they don't like Fiverr because they believe like the freelancers that create thumbnails, they might be replaced in the next 2 years by AI, which is true. But if you look what Fiverr are doing at the moment, they're going, yeah, that could potentially happen. So that's why we're focusing on the higher end products where we actually have AI designers. Now, at the moment, AI cannot create AI designers at the moment, but that is going to have major growth. So Fiverr have pivoted with the AI boom, and people are looking at Fiverr having the AI impact as a bit of a headwind. I believe what people aren't realizing is Fiverr's actually sitting on a big tailwind with the AI boom, because people are going to need them AI developers, and that's what it's focusing on. It's not focusing on the work that's going to get disrupted by AI. So I think this is a big tailwind that people are thinking headwinds at the moment and getting a little bit lost in it. And that was very clear when if you looked at the recent earnings and went through the conference call and you've been doing your research on it, you would have been able to see that is going on in the business at the moment. And yeah, all for 11 times earnings. And as well as that, they are currently doing a 100 million share buyback program. So when you are a company that's valued at 976 million, yeah, that's over 10% of your whole market cap, which is very impressive. So I did buy a little bit more Fiverr. So the next stock I bought was Dlocal. So yeah, not as confident on this one as the last couple that have been mentioned on here. I did buy some more Dlocal, and it's probably the last time we're going to buy Dlocal until they bring out their next set of earnings. I've got to see an improvement in the next set of earnings. If there's not an improvement, I might actually see Dlocal. I might sell Dlocal out. But I'm going to buy some shares at $9 and see what happens. And then when the next earnings report comes out, I'll go, okay, that was worth buying some shares. And then I'll keep buying some more once I see that the business is improving. If it's another bad report from Dlocal, I might sell. So I'm just letting you know that I did buy some Dlocal, but I'm still on the fence if I'm still going to hold this for long term, because I've got to see a good report come out from them next quarter. And I'll show you what I need to see them do in the next quarter for me to still be a shareholder. Now, I won't go into the full earnings report because the full earnings report really hit the stock, as you can see here. Big drop off the earnings. There was a few negatives in here. I talk about it on this video. It's 22 minutes long. I'm not going to do 22 minutes talking on Dlocal's earnings again, because if you do want more detail, you can go check that out and you can see the things that I didn't like in the earnings report, but there was a few things I did like, but you can see a full recap in that video here. A quick thing that I'm kind of looking at with Dlocal though, 19 times forward earnings, not that bad, especially with a company that's growing 34% year over year. That's actually really good growth for 19 times earnings. And what they're doing is they're capturing a lot of their fintech offering in Latin America. Latin America fintech is growing massively at the moment, and they are doing very well from that at the moment. As you can see here, total payment volume was up 49% year over year. So there's no issue with the payment volume, there's no issue with the revenue growth here. The big issue with Dlocal is the profitability. Now, the two issues that I have is that one of the clients, one of the big clients, was renegotiated one of the fees, which I don't like. That shows me that if a big client can renegotiate a fee, are they all going to do it? So that was a big impact that happened that I didn't like personally, and I'm watching that as well. The other thing is that they said they were investing into the business for longer term opportunities. So if you look here at the growth was good. However, none of it hit the bottom line because the gross profit was a little bit flatter because of a lot of the client changes, but then they reinvested very heavily into like technology and development, as you can see here. G&A was up a good chunk, and that's why the profitability was disconnected from the revenue. So I'm looking at the next quarter now that they'll report in the Q2 quarter, and I'm looking to see, okay, did this reinvestment they talked about, is this actually going to start paying off in Q2, and then we're going to see the company start, keeping up that profitability, start improving in the right direction? That's the big thing. If I see a quarter where the profitability is hit again, I'm probably going to sell out of this. If I see another quarter where the profitability does start ramping up and the revenue carries on growing, I'll be going, hold on, this could be a potential good gift here at $9. So the next quarter is a really big one from Dlocal, and I hope it works out, because the company throws off a ton of profitability. I mean, look at the profitability they throw off at the moment. Balance sheet wise, they've got a cracking balance sheet, as you can see down here as well, no debt on there, and because of that, they're able to throw off a lot of share buyback. They just announced a 200 million share buyback, as you can see here, which is once again, for a company that is around about 2.7 billion market cap, is a very decent share buyback for a company of this size. So yeah, I think it'll be okay. When you look at, there's no issue around the growth, it's just the profitability, and I think maybe they've just not managed the profitability well at the moment, and hopefully that does start improving. But I'll let you know in a couple of months' time when Q2 comes out, where I'm a little bit more out of Dlocal. I had to put it in the video because I bought it and I want to be transparent. However, I'm not saying that I'm as confident in this one as a lot of the ones that I've mentioned in this video here overall, is what I'm trying to say. Anyway, and the fifth stock and the final stock is Shopify. So I did buy some shares on Shopify. They reported their earnings. The stock had a drop off earnings, as you can see here, quite a big drop, and I was blown away because I thought the earnings were very good. So with the stock dropping nearly 20% and the earnings being very good in my opinion, I was going, okay, I'm going to buy some Shopify, and I'll continue to buy Shopify on this dip because I think Shopify is a brilliant company. I would say it's probably one of the best moat companies that I own from a business point of view, that I'm just confident they're going to be around for many years and continue to grow for many years. So if you give me a 20% dip on it, I'm going to buy it. And just to show you how good those earnings were, EPS was a beat by 0.03, revenue of 23% year-over-year growth, and that was also including that they sold off the logistic business. If it wasn't for the logistic business sell-off, I think it was like 29% year-over-year growth, and they beat by 10 million as well, as you can see here. So I don't know how you can have a company that beats their EPS by this much, growing it this much, beats on the revenue, and then it drops 20%. It's like, what else did the market kind of want here? Is basically what you wanted to see from Shopify. Now, I'm sure most of you guys are aware, but Shopify is a platform that helps you set up your online business on a website. So if you want to set up an online website, go on here, it'll host it for you, and the fees are pretty good, and they also offer a lot of solutions as well and extras for you to help manage your business. And from where they were just an online platform in 2006, today they offer the sites of brick and mortar stores, marketplaces, so you can sell on like eBay, Amazon, access to social media, pop-up stores, and B2B as well. And if you look at all the things they can do, they can create that app for you, so you have an online shopping app, give you all the marketing and analytics, so it shows you how you can potentially sell through Google ads or Amazon ads, and gives you the data on what's going really well on your website, who's clicking on what part of the product. Cross-border, so if you want to expand from being a US business and you want to start selling in England, they handle all that for you. Order management, so you don't even have to go to the store cupboard, you just click on your website, how many you got left in, and you'll be able to see without going to the storeroom. This is what's currently going on at the moment. An office, so you can see what everybody's working on inside your business. Shipping as well, where's this product at, who's got this, has this arrived at their house, all these sort of features. And there's also more to it as well. These are some of the brands that are currently using them. Loads of big brands, as you can see here, that are now using Shopify. I think you are falling behind if you actually don't use Shopify as your selling site. These are some of the new brands that they've also taken on recently. And if you look here, ShopPay, one of the new features they add in, so they are able to take the payment for you, and also through credit as well. If you wanted to payment through credit, faster checkout, and you can see here that up to 50% higher conversion rate when ShopPay is used. 150 million buyers opting into it now, and GMV growth in Q1 2024 up 56%. So you can see this is still a very high driver of growth for them. And they just keep adding more features in, like Shop Pay, for example, that will just keep expanding Shopify's client base and the income they take from people that use their platform. Now, the big thing you have with Shopify is that it's a bit like Crowdstrike. It's never been a cheap stock. It never has, and it never will. You will never get Crowdstrike at 20 times. You'll never get Shopify at 20 times earnings. It just won't happen because it's a high quality business. It's one of the best businesses out there in the whole stock market. Now, at the moment, it does trade at 73 times free cash flow. What do you pay up for this? I don't know, because obviously you got a company growing at 20+%. It would have been nearly 30% without that logistic issue at the moment, which is very high growth. Cracking balance sheet, probably an untouchable business that are always adding these features in. E-commerce the next few years is just going to continue to grow as well. I don't know what exactly you pay up for it, but I've got to say, when your free cash flow is at the lower side, I mean, the lowest it's been at the moment has been 71. The average is 367 times free cash flow, but I mean, that's just absolutely bonkers, isn't it? But you're currently 73 times free cash flow. I mean, there's a chance that this stock maybe goes down to 30 times free cash flow, but it's one of those stocks that I'm just confident you hold this stock for the next few years. I think you're still going to do very well from this stock. And if you're ever going to, I mean, at the moment, it's the same price, or it is higher actually before the whole CV situation. Obviously, it's been on a very good run. It's having a healthy pullback, maybe. I'd say probably too healthy of a pullback now. Down 34%. I mean, you're getting Shopify down at 34% on a dip at the moment. I think for a quality business like this and what you're getting here, I don't think it's that bad. And it is hard to value this sort of business, but I think that it's such a quality business that I'm willing to add it at these sort of levels. And the last one is, what did I sell? So I did sell a business in the last few weeks. Won't be a surprise to many of you guys, but I did sell my Corsair position. So I did take a loss on this one. I think it was around about a 40% loss that I took on my Corsair position. So a little bit of a stinger there. It wasn't a huge position, but it definitely did hurt taking the loss there, which wasn't good. We never want to take a loss on a stock. But I just got to the point of view where I was like, you know, I'm just having this money sat here. The money that I can take out here, I can go invest in another stock, and I can probably make up the return in Corsair, the loss I took, by buying another stock at the moment. And rather than hoping and praying it works out and you do improve, I actually take control of the money and go invest in something and make that return up, and it can easily recoup those kind of losses from Corsair. And I was looking at Corsair going, I mean, it's not a relatively cheap company, 16 times forward earnings for a company that's declining revenue. I mean, that's not cheap, is it? And the recent earnings were just shocking. The recent earnings was what really shoved me to sell the stock, because the EPS was a mega miss. The revenue was a mega miss. I mean, 337 million and missed by 25 million. Negative growth when they were supposed to have positive growth. And there's been a lot of things that I haven't liked with Corsair. But the couple that stood out in this quarter is that the feedback I've got from some of the products is that they've got worse in the last few years. That's never what you want to see. The other thing that I didn't like is that management team basically came out and said, we thought this quarter was pretty good. Now, if you're doing these numbers, missing by EPS by this much, revenue missing by this much, and you're saying it wasn't a bad quarter, that's not good enough for me. That's management. That's a big red flag from management team. It's also not looking that cheap for the numbers they're doing. They didn't change their outlook, which I was like, there's no way you can miss by this much and then not change your outlook. I was like, that's another red flag. They did the classic thing of saying, oh, but we'll have a strong second half. I've seen companies do that many times where they'll say, oh, we'll have a strong second half, and it doesn't happen, and you end up being burnt from that point of view. Corsair have done it couple of times before, so the fact that it looks like they're going to do it again, I was like, you're not doing me this time, I'm out of this one. So I also thought that was also a bit worrying, that they were not changing the guidance and then saying, oh, we'll recover in the second half. I was like, I don't know. And the fact that they've always said, like, they've always got to the point of view where they've gone, oh, there's all this promotion going on in this area at the moment, and as soon as the promotion's gone, we'll do really well. And that's what they've said all the time. And we're now getting, obviously there was the big CV boom where everybody upgraded their kind of PCs, and it's taken a while for us to kind of get back to normality. But we're nearly 2-3 years on now since that big boom, and if you're still not starting to see that kind of improvement here, it's a little bit worrying to me. And there's also a few other companies in this area that are showing a little bit more positive signs. And then how big the miss was just so worrying to me. And I thought, you know what, let's cut it here, because me holding this stock right now is just like, I'm hoping it's going to work out and they'll start improving it. And if I ever get to the point of view where I'm with a stock and I'm hoping it's going to improve, that's not good enough. If I've got actual reasons why I think it could improve from here, I'm happy to hold that. When I see a company that maybe isn't doing well, like Dlocal, for example. We talked about Dlocal at the start of in this video, and I said, with Dlocal is that I'm a little bit worried about them, but I'm still happy to hold them. In fact, I'm still going to actually have a little bit of a nibble on them. I am a little bit worried about them, but what I'm seeing is I'm still seeing the fundamentals of the revenue growth and the TP, the total payment volume is still increasing. The only thing is that they've just increased cost way too much. So I'm not seeing a broken business, I'm just seeing someone not managing the cost that well. And I can see them hopefully going, we haven't done a good job there, but we can turn it around. I'm seeing a company here that has management team that are, happy with bad financial performance, negative growth, valuation not very good. I'm seeing the reviews of the actual service getting worse as well, which is not what you want to see. So I was like, let's just move out of this one now, and that's what I decided to do anyway. So yeah, I did sell that stock anyway. So those are the stocks I bought, the 5 stocks I bought, though that is also the one stock that I did sell in this period of time as well. So yeah, hope you enjoyed the video. Let me know what you've been buying as well in the comment section. And apart from that, I'll see you all in probably a couple of days time anyway. See you in a bit, guys.